ሰላም ጤና ይስጥልኝ ክቡራንና ክቡራት የመቅረዝ ሚዲያ ቤተሰቦች እንዴት ናችሁ? ሰላም ናችሁ ወይ? ዛሬም በላይቭ ተከስተናል። በዛሬው የላይቭ ቪዲዮ ላይም አንድ ያስተምራል ያልኩትን ስለ ፊክስድ ማርኬት ኢንካም ወይም ስለ ቦንድ ማርኬት የሚተነትነውን ርዕሰ ጉዳይ እናንተ ጀባ ብያችኋለሁኝ። እስከ ዝግጅቱ ፍጻሜ ድረስ አብራችሁን ቆዩ። ጉዳዩን በደንብ ተማሩበት። ለሁላችንም የሚጠቅም ነው። ወደፊት የኢትዮጵያ ካፒታል ማርኬት ስራ ሲጀምር ኢንቨስት ማድረግ ስለሚጠበቅብን ለዛ ኢንቨስትመንት የሚጠቅም ስንቅ የሚሆን ነገር ይሰጠናል ብዬ አስባለሁ። ስለዚህ እሱን ጋብዛችኋለሁ። እስከ ዝግጅቱ ፍጻሜ ድረስ አብራችሁን ቆዩ። ስትገቡ ደግሞ ላይክ፣ ሰብስክራይብ አድርጉ። ቤተሰቦች አዳዲስ ሰዎች ከመጣችሁ ደግሞ ሰብስክራይብ አድርጋችሁ ቋሚ ቤተኛ እንድትሆኑ በአክብሮት ተጋብዛችኋል ማለት ነው።
I've worked with pension plans and retirement systems my whole life. And the way I think about fixed income is I come at it from my actuarial side, where I think about the liability, the obligation that I have or an investor that I'm working with has, and that's to fulfill this obligation to make a payment at some point, to make a pension payment, to be providing income to a retiree at some point. And so the idea that I'm thinking about and working about, the perspective that I have is I have this payment, it's 20 years from now. And if I have an investment that will deliver me a cash flow 20 years from now, at the same time I need to make a pension payment, then I like that asset. And if it's a high quality asset that I have confidence in delivering that cash flow, it's a very good asset for me. It eliminates all my risk, and it eliminates investment risk, it eliminates liability risk, because it's going to deliver the income I need to make the payment that I'm obligated to make. So that's the way I think about it. It's an asset liability management perspective, an ALM perspective. And a lot of fixed income investors will think that way, but there are certainly other reasons for investing in fixed income and other perspectives. So I go around to different countries. I'm often educating, kind of like I'm doing today, and often educating about asset liability management. But of course, when I go to a country, I want to know a little bit about the country, know a little background about the economy and the capital markets and so on. And so the first thing I look at, I'll just give you a second to ponder what the first thing I look at might be. The first thing I look at to know something about the local economy is the 10-year bond yield, the yield on 10-year bonds from the local government. And so if I only had one thing to know about the local economy, it'd be the 10-year bond yield from the local government. And the reason is that you can read a lot from just that single item. You can know a little bit about economic growth. You can know a little bit about inflation. You can know a little bit about expected stock returns. And so there's a whole lot of information and just kind of a perspective background on the local economy just from that single item. Better yet is the whole yield curve of interest rates on bonds from the local government. Then you have an even greater perspective, the slope of the yield curve, the extent of the yield curve, how far does it go out, the interest rates at the short end of the curve, all providing lots of information. So these interest rates and this progression of interest rates as they go along the term structure, very useful. And those are the things that I look to initially understand the local economy. So this fixed income stuff that we're going to talk about, fixed income markets are amazing, huge, complex. Typically in most countries, the fixed income market is bigger, and certainly worldwide, the fixed income market is bigger than the equity market. But it's also a lot more complex. I mean, a single company is often going to have just a single equity security out in the market, but they may have many, even dozens of fixed income securities out there, different maturities, different structures, different covenants and provisions on their fixed income. So, and there's, we'll talk about in a second, many different kinds of fixed income. So just lots of interesting complexities to learn and understand in the fixed income world that you don't have in the equity world. And we'll try to cover some of those today. We only have 45 minutes, and to cover this giant complex world in 45 minutes is a daunting challenge. We're not really going to cover it in any depth, but what I'm going to try to do is just give you basic concepts, theories, get the ideas out there, get the terminology out there, so that then you have a basis to go further, to investigate these things further. Some of this will just maybe cement stuff you already know, and some of it will maybe be a little new and add to what you already know, and some of it will just be background for further investigation. So here's kind of a structure to things. I'll talk about some background, talk about some kind of math and analysis that you do in the fixed income world, and then talk about actually investing and what different perspectives different investors bring to fixed income and why they invest in fixed income and how they do it. So first, investment objectives. So what are investors trying to achieve when they invest in fixed income? So the first thing I think that an investor, at least in the US, would think about is it's just diversification. So the kind of the primary investment vehicle, the primary asset class is equities. And I've got these equities, they're gonna provide return for me. I'm gonna have more money in the future because my equities are providing this return. But my equity portfolio value is gonna go like this. It's gonna go up and down. It might be way down here at some points. It may lose 50% of its value at some point. And so I think about the bonds that I invest in as just providing stability to that up and down, uncertain nature of returns from equities. And I just want to smooth it out a little bit by having bonds in the portfolio. The second reason is the one I talked about before, matching obligation cash flows. If I have an obligation to make a payment at some point in time, whether it's as an insurance company, a pension plan, it could be investing for college or buying a home where I want to have money available at a certain time. I can use fixed income to provide that very predictable cash flow to make those payments. Predictable income, so corporations may want just predictable, stable income from the cash that they're holding on their balance sheet. Retirees want income during the retiree period, and fixed income can provide that. And then, of course, return. I may invest in some riskier, higher returning fixed income to provide return in a different way than equity. So very different objectives, a different approach to thinking about investing when I'm thinking about fixed income versus equities. And of course, then the risks are different as well. In equities, again, I'm going to have this up and down, different value of my equity holdings as things progress, as people and investors have different perspectives on the future of a particular company, on the future of the economy, the way profits are going to grow, the way they might be worried about the management at a company and that profits are going to drop off. So that's what I'm worried about in the equity world. In fixed income, really it's all about interest rates. If I'm going to be trading fixed income in any way, interest rates are my first concern and what I'm really thinking about first and foremost. If interest rates change in the wrong way, the value of my fixed income investments change. But of course, I'm also worried about default, that whoever's issued the fixed income invested in isn't going to be able to make the payments that they've promised. And even before they actually default, I may be worried that the risk of them defaulting increases such that the value of my bond decreases and I'm not able to trade it at as high a price. So different types of risk in the two worlds. So really what we're talking about here is the cost of money. Money costs something. Money's a resource, and we have to pay for it. And we pay for it by paying interest, providing a yield to someone that loans us money so that we can use it for whatever purpose it is, buying a car, making investments at a corporation, as a government. I'm using money to pay the general expenses of the government, but I have to pay for that. I pay interest rates, And so there's all types of different borrowing, and fixed income investments are just another type of borrowing. So I'm interested in these things at the bottom of the chart when I'm interested in investing or in issuing fixed income. I'm interested in how long the loan is going to be for, what rate I'm going to pay for it, whether that rate's going to be fixed or variable. I can pay off the principal in different ways. So those are some of the key things that I'm interested in when I'm doing any type of borrowing. And the interest rate, maybe first and foremost, is what we look at when we're taking out a mortgage, when we're issuing a bond, when we're buying a bond. And the interest rates are really the cost of money. So interest rate, we can think about interest rates from a supply and demand perspective. So high interest rates really are a blessing and a curse. For the high interest rates mean that it's hard to get money. Money is expensive. If I want money to use for something, then it's expensive to get it because I'm going to have to pay a high yield for it. On the other hand, high yields are a good sign in the sense that if issuers are able to, or lenders are able to charge a high yield, that means that that investors or those that are using the money are able to find good uses for it even at that high interest rate. So corporations that are borrowing money at a high rate are able to use that to produce profits they expect at a high rate. So high interest rates can be a good sign in that sense. So lots of different types of fixed income investments, as I mentioned, different types of government bonds that can be issued, all different types of corporate bonds, different bonds with economic, social, and governance type objectives these days, green bonds, sustainability bonds, which have a little bit broader perspective beyond the environment than green bonds. Asset-backed securities, so this is a kind of a bond that's becoming more popular and is used a lot in the US and other developed countries. I'll talk a little bit about it in a second. Sukuk, so in the Islamic world, a Sharia-compliant bond replacement. So lots of different types of fixed income investments. As Mike was saying, we could spend a course on any one of these different types of investments, but we're really just going to go over basic concepts. So let's talk about a typical bond, a conventional type bond, and just what it is, how it works, so we have this clear in our head. So the investor who's going to earn money off the bond loans money to the issuer. The issuer is a corporation or a government, so they're borrowing from the investor, and of course they're going to pay back the money over time. And in a typical bond, the money gets paid back every 6 months. So there's what's called a coupon. That comes from the fact that originally bonds were just pieces of paper. They had little strips, coupons on them that you tore off and turned in to get your interest payment. So the coupons are interest payments. They're made twice a year. So if I have a bond that's paying me 10% interest, each coupon is going to pay me 5%, so that the total at the end of the year is the 10% annual interest. This is a 3-year bond, so it's making a coupon payment after 6 months, 12 months, 18 months, and so on until the end of the 3 years, at which time the original loan paid off. So this is just the basic structure. Most of the world of bonds, both government and corporate bonds, follows. Now, there's two different types of bond investors. Well, there's many different types of bond investors, but let's just start off by categorizing them into two camps. One is the hold to maturity, the investor that's going to buy a bond and then hold it until the end of its term. So that investor is going to get all these coupon payments. They're going to hold the bond the whole way, get the final coupon payment, get the return of the original loan, and hold this the whole way. That investor is not so worried about interest rates during this time because each of these payments is fixed. It's already determined in the original agreement between the investor and the issuer. And so an investor who holds to maturity is not worried about how interest rates change. An investor who intends or possibly will trade the bond is worried about interest rates or interested in how interest rates change. Because if I have a bond that's paying me 10% interest and interest rates in the economy go down, now my bond that's paying 10% based on the way the economy was when I bought it, maybe the similar bond in the new economy is only providing 7%. Now my 10% interest is worth more. So a drop in interest rates has increased the value of the bond I hold. Same thing if interest rates go up, now my bond is worth less. So even though I'd like to get paid 13% interest on a bond, and that bond is worth more than a bond that pays 10% interest, if I already hold a bond paying 10% and interest rates go up, the value of my bond decreases. So this basic idea that when interest rates change, the value of bonds change is absolutely essential to understanding bond investing, thinking about bond investing, and operating in the bond market, understanding interest rates. And we'll come back to that several times as we go through. Here's a different kind of bond called an amortizing bond. This is the way a lot of mortgage loans are set up. And here, instead of the principal being paid back with coupons and then all of the principal being paid back at the end, the principal is paid back gradually over time. Gradually over time, I pay less and less interest because I've paid off some of the principal, so I have less and less loaned out. Therefore, I pay less and less interest on it. And by the end, I make a final interest payment and a final principal payment. And it's just another structure for getting money back to the investor, the entity that loaned the money. This is a little bit lower risk to the investor because the principal is being gradually paid back, so the principal is not all pushed back to the end of the term. An asset-backed bond is a different type of entity, but it's worth knowing about because of its popularity in different places. So what happens here is that a whole bunch of loans of some kind, they could be mortgage loans, they could be car loans, they could be credit card loans, together, and the payments from these loans go to some kind of entity, some issuer, some investment bank, say, packages them together and then separates them out into different tiers, and they make the first payments to the investors in the investment grade piece of this. A higher risk piece gets paid after these, and then the lowest risk piece, called the equity piece, gets the last. So any loans that are that default here, the default is first applied to this group, and any payments that don't come through here because of defaults decrease the this piece first. So this piece is higher or lower risk. This piece is higher risk and gets a higher yield because of that. So just another way to structure a fixed income type investment backed up by securities, loans, and it's a way of monetizing these loans for whoever holds them. Okay, let's talk a little bit about government debt versus corporate debt. So, of course, the basic idea here is exactly the same. Government needs money to do all the things they do, build roads, build bridges, provide assistance to people. Corporations need it to invest, to pay their workers, and so on. And so they loan money at times to cover those expenses. But government debt and corporate debt are different in important ways. So, of course, government is their payments on the money they loan are backed up by tax revenue. So what's important to understand about the government is their tax revenue source, the government budget, how close is the budget to being balanced. There's political risk that's involved there. And so as an investor in government bonds, even though they're technically low risk and even considered no risk in many places, you're paying attention to how well the government is set up to make the payments back. In the corporate world, of course, it's all about the profits and the money that the business is bringing in to pay back the loan. So we've got a different type of risk for each type of loan that the different entities are taking out. A couple other key things here are a government bond is typically issued through an auction process. So the government, or sometimes through the central bank, puts government bonds out through an auction process. And anyone interested, could be individuals, more likely institutions, banks, pension funds, insurance companies, put in a bid, the yield that they would accept on a particular term of bond. A 2-year bond, we're willing to pay X percent. A 5-year bond, we're willing to pay Y percent. And the government issue is filled up to the extent that the yield or the bids fill that up. In the corporate world, bonds are issued through an underwriting process. So an investment bank typically will work with the issuer, the corporation that's issuing the bonds. They'll go out to the investment bank will go out to their clients, assess interest amongst their clients about investing in the corporation's bonds, find out what yield they might be willing to accept, and that kind of thing, and eventually then issue the bond to the different interested investors that the investment bank has connected with. So different processes. The corporate bond then is also, you're going to be more interested in the different provisions that are part of the bond covenant. So there'll be requirements in the covenant for, there'll be financial requirements, profitability requirements perhaps. There'll be requirements about levels of debt, so you're going to restrict the corporation to not taking on too much other debt. The corporation, on the other hand, may want to have a call provision in the debt, which allows them to pull the debt back in. They can buy it back from the investors, pull it back in, and then issue other debt in place of that. We can come back to that, talk about that a little more later. All right, so let's talk about a few bond markets out there and just get a sense of the size of things and kind of the relative size of government and corporate bond markets. You can see here the U.S. bond market. These numbers are a year and a half old or so, but the total market in the U.S. is about $50 trillion and about the same size, government and corporate. United Kingdom, much smaller. Japan has huge level of government debt, as you might know, and so they have a big government debt, government bond market in Japan. Many Japanese citizens own government debt, and it's a big thing in Japan. Then some of the developing countries, you can see the statistics there from fairly large in China to much smaller and more developing bond markets in other countries. Vietnam and Bangladesh are maybe of interest. I was telling someone earlier about Vietnam. Vietnam has put a lot of energy and a very dedicated focus into developing a corporate bond market. And the story there is very interesting to follow and maybe can get shared with you at some point, because I think there's lessons to learn there. Bangladesh is on here because I taught much of this material to institutional investors in Bangladesh. They're trying to establish a corporate bond market. And so you see that they have some issuance of government, but really no issuance of corporate debt yet. So I think it's a common situation that government debt is out there, but lots of developing countries trying to develop their corporate bond market. Okay, let's turn to some other concepts here. There's going to be some questions throughout here, and the questions that come up, I'm not going to answer them for you. I'm just going to pose the question to you, and you can think about the answer, and hopefully the answer will come on the next couple slides. But I think it's useful to have some question in your head as we go through the material. So the first question here is, if interest rates go up, what happens to the value of a bond held by an investor? So first, let's just cover some definitions. A lot of these terms may be familiar to you. The time until the final payment is the maturity of the bond. Coupon payments we just covered. Default is when the loan can't be paid back. Par value of the bond is the face value of the bond, but it's not the market value of the bond. So the market value of the bond is going to change when interest rates change. So often the face value is equal to the market value right when the bond is issued. But as time goes on, the value of the bond changes. It may be because interest rates have changed and the value of the bond changes, we talked about before. Or it could be because if it's issued by a corporation or a government, the confidence in that issuer has changed. And if there's more worry about the ability of that entity to pay back the money that it's loaned or borrowed, the value of the bond may decrease. So par value is the original value, not the market value. Present value is very important. You discount future payments with discount rates, often using the Treasury yield curve as a discount rate to establish the value of any bond that you hold. Yield is a very important concept, and so we talked about coupon yield, but eventually as interest rates change, the coupons that you're receiving are not going to define the actual yield that you're getting on the bond. So we'll talk about yield to maturity, then yield curve we'll talk about second, and credit spreads we'll talk about. So what's the difference in duration of a 10-year zero coupon bond and a semi-annual coupon bond? Zero coupon bond is a bond just like the 3-year one that we looked at, but it doesn't pay coupons. It doesn't pay interest along the way. It pays all the interest back at the end in the final payment, and then pays back the original loan as well. So there are no coupons, final payment made at the very end. So a 10-year bond would have no payments until 10 years from now. And so this question is about the duration of something that just gets paid once in 10 years or something that gets paid gradually over time with a final payment at 10 years. And so we're about to cover the concept of duration, which is a vital one to bonds. So duration really covers two concepts. The first one is it's the weighted average maturity of the payments that are being made on the bond. So a 10-year zero coupon bond that just makes a payment 10 years from now has a duration of 10 because the weighted average timing of the payments is 10. The coupon bond, 10-year coupon bond that makes payments gradually and then also makes final payment at 10 years, the weighted average time is going to be somewhat less than 10. So the duration of the coupon bond is less than the 10-year bond. Now, the timing of the payments also define the interest rate sensitivity. So the longer a bond is, the more interest rate sensitive is. When you discount the future payments with discount rates and get the present value today, the change in value is going to be different for a longer bond because you discount over a longer period. If you're discounting at 5% for 20 years, you get a bigger impact than if you're discounting at 5% for 5 years. So the duration is also a measure of interest rate sensitivity, and that's really what we're interested in when we're thinking about bonds. Again, if we're holding the bond all the way to maturity, we're not really so concerned about the duration of the bond. We know we're going to hold it. We know the payments that we're going to get. We're not worried so much that the value may be going up and down as time goes on. But if I potentially am going to be trading the bond, or if I'm accounting for it on my books in a way that I need to keep track of the value, then I'm going to be concerned with duration. Now, so the 10-year bond that has the zero coupon bond that has 10 years of duration is going to change by 10% if I move interest rates by 1%. So duration in terms of interest rate sensitivity tells me what percentage the value is going to change by if interest rates change by 100 basis points. So if interest rates go from 5% to 6%, we know the value of the bond is go down, right? So the value of the bond is going to go down. And if the duration is 10, if it's a 10-year bond, we know the value of the bond is going to go down by 10%. So duration defines the impact of changes in interest rates on the value of the bond. So now we're going to talk about yield curves. Interest rates for payments further in the future are usually higher, about the same, or lower than interest rates that are coming soon. So in order to define this and talk about yield curves and the structure of a yield curve, the term structure of rates, we're going to start by talking about central banks, because central banks really define the interest rates for us. And so we got to start here with what the central bank is doing. Here's a list of central bank functions. They hold deposits for the government and for commercial banks. They usually hold securities, and through holding those securities, they're going to control rates. They're going to control the money supply. Sometimes they issue their own securities. And by issuing their own bills, they're going to also control the money supply and interest rates. But it's through through these different functions that they control the money supply and interest rates. And so let's just get clear about how that's done. Here we've got 3 different central bank actions, and these are really just a sample of the types of approaches a central bank can use to control the money supply and thereby control interest rates. So one is to decrease rates on the deposits. So if banks are going to get less on their deposits with the central bank, then they're going to loan money out. They're not going to hold as much money with the central bank. They're going to loan more money out to the economy. That's going to put more money into the economy and thereby increase the money supply. Another way we talked about, I think it was Mike, or maybe it was Victor, that had the open market operations, go out and buy securities from banks, take the securities off the bank's books, but give them cash. Now the banks have more cash. Now they can make more loans. Money goes out into the economy, increases the money supply. The central bank, again, could issue securities. They could issue securities, have them bought by banks. Now the banks are paying the central bank. Money is going into the central bank away from the commercial banks, and therefore coming out of the economy. That lowers the money supply. So now when there's more money, just going back to our basic idea about how interest rates are affected by money, if there's more money, that means it's cheaper money. That means interest rates go down. There's more money out there, it's going to be cheaper to get, higher supply, lower cost. Interest rates are going to go down. If there's more money, there's going to be more spending, and more spending is going to lead to higher inflation. So more money means both higher inflation and lower interest rates. And of course, we've had a lot of that in the world in the last 10, 15 years. Central banks pushing more and more money into the economies. thereby pushing down interest rates and increasing inflation, and only just recently have reversed that in a pretty severe way. So then we get to yield curves. The central bank really controls mostly the short end of the curve when they enter into the type of action called quantitative easing. They're trying to go further out on the curve and impact rates further out the curve. But generally, the central bank is impacting the short end of the curve, and then the long end of the curve is being taken care of by the market. The market demands a risk premium. The longer they've loaned money for, the more yield they want to compensate for that. So yields further out on the yield curve are higher. There's more risk. There's more risk that a default will happen. There's more risk that inflation will change and increase. So inflation is the enemy of bondholders. Bondholders are getting fixed payments generally. We talked about there are variable yield bonds, but generally bonds are fixed payments. And so when interest rates increase, or when inflation increases, the spending power of that money that fixed amount of money that's coming back drops. So inflation is the enemy of the fixed income holder. And so inflation risk is a lot of what drives the risk or the term premium, the higher rates that one gets for being vested further out on the yield curve. So this is just summarizing some of the issues that impact the term premium and the slope of the yield curve, how much it changes from the short end to the long end. And again, bond payments are fixed, so higher inflation reduces the spending power and therefore their value. So inflation is a key issue and concern for fixed income investors. So let's just stop now and think ahead, I guess, and think about what a healthy debt market would look like. What would be the characteristics of a market in a country that was working well for both the investors and the issuers? So bond yields would be higher than inflation. So investors could be earning something over and above inflation if they loaned money to either the government or corporations. Inflation is under control, so I don't have to worry too much about what it's going to be 5 or 10 years from now, and I can invest confidently over longer periods. That would mean that the yield curve is sloping gradually upwards. Yield sloping up means possibly that investors have confidence that the economy is going to be growing. So upward sloping yield curve means growth. An inverted yield curve is often a sign of a potential recession. You can buy bonds quickly and sell them quickly. So especially government bonds, you should be able to sell and buy relatively quickly in a healthy debt market. There's a lot of liquidity so that you can make transactions happen within a short time period. So debt issuance beyond 10 years is available. So as an investor, as thinking from my perspective as a pension plan or as an insurance company, as a person saving for your retirement, you'd like to have some longer issued debt available that provides for that time when you actually need the money. So debt issuance beyond 10 years is available. That also means that people have confidence in the economy 10 years from now, not worried about the economy blowing up or inflation blowing up. It also means that the issuers are getting what they want. Issuers would like to borrow over a longer term. They'd like to get the money and not have to pay it back for a long time. So if I've got a reasonable yield on debt beyond 10 years, that's a great thing for the issuers. And then corporations that are using a mix of debt and equity financing for their business are going to be healthy businesses. They can choose their debt and equity proportions in a way that suits them best. Debt is usually cheaper than equity, but too much debt can cause problems, can leverage the company up to too great an extent. So these are just some basic ideas that can kind of help envision what a healthy debt market eventually might look like. So thinking ahead, here's just a couple slides for a market that's maybe a little bit ahead. Again, I spoke to Bangladesh about a year ago and was educating on some of these concepts. And here's a yield curve from Bangladesh from just a year ago. So you can see a lot from this. So one, they have issues out to 20 years. So that's a nice thing. This is the government bond yield curve. It's a nice upward sloping curve. The middle of the curve there, you can see the 10-year yield is just a little above 6%. So you know something a little bit about growth and inflation, and potentially they don't have equity market there, but you can see a lot, understand a lot just by seeing this yield curve. Here's another thing then that I'd like to look at when I go someplace is I like to look at the maturity profile of the government bonds that are out in the market. And here you can see on the left the maturity at issue. So Bangladesh was selling 2-year bonds, 3-year bonds, 5, 10, 15, and also 20-year bonds. And then over time, after say a 20-year bond is sold, its maturity, time to maturity is 18 years, 15 years, and so on. So you can see on the right, the maturity of the bonds that were outstanding at the time of this chart. And this is pretty typical that short-term bonds would make up the majority of the issuance that's out and available. Long-term bonds would be less, and just gives you a little sense of, again, what a developing market might look like in terms of its maturity profile. These are the government bond. Considerations related to government bonds. These are both for issuers and investors. Institutional investors would have different considerations than individual investors, different times to maturity that they wanted, different levels of yield that they were interested in, different covenant requirements that they're interested in. Individual investors would often be invested in funds, a diversified portfolio of bonds rather than individual bonds. So there's a big difference there. Central bank may be an investor in government bonds. So the central bank is buying bonds, again, to help control the money supply. Government may be lending money to other parts of the government. So they may be lending money, say, to a social security system. That's the intergovernmental debt. Governments can lend in different currencies. And then inflation indexing. In a country with high inflation, inflation indexing is very important to investors. If you're a retiree and you're wanting to provide for your retirement, having a bond that pays 5% when inflation is 6 or 7% is tough, and especially if you don't know whether the 6 or 7% may go up or down. So indexing debt is and the considerations around providing that are very important to a government in where inflation is an issue in the economy. Corporate bond investing, I'm just going to skip over this quickly. Obviously, significant advantages for investors and significant advantages for the issuers as well. Risks related to the bankruptcy of the company and just the market perception of potential bankruptcy changes the value of a bond. So let's talk about this a little bit. See, in the corporate bond world, there's really two parts to the yields that we're getting. One is defined by interest rates, and by interest rates, we really mean government bond yields. Government bond yields really define the base interest rates in an economy. And then for any particular company that's issuing debt, there's a credit spread above that to recognize the additional risk of the company defaulting. So we think about corporate bond yield as in two pieces: the interest rates and then a risk premium above that, defining the specific risk for the company. And here's a diagram of the credit spread split out even further. So first of all, we're showing that as time increases, as the maturity of the bond increases, the yield is going to increase. That's just that increasing yield curve idea. So all the different pieces of the yield are increasing as we go further out. But the credit spread is made up, this is a little bit simplistic, but you can think about it as made up as one, compensation for defaults that might happen at the corporation where they were not able to pay back. A risk premium, so over and above the expected value, an additional premium paid because there are potential defaults, and then a liquidity premium where the corporate bonds are not likely as liquid as the government bonds, and therefore there's some extra yield paid by corporations for that reason. So that's a breakdown of the credit spread. Here's just a picture of the credit spread as a yield curve. Just the difference between the government bond yields and the corporate bond yield. Yield to maturity, so a very important concept here. Yield to maturity is the yield on a bond at any point in time. So we have the yield defined at the beginning when the bond is issued, which is based on the coupons paid and the final payment being made. But if the value of the bond changes as interest rates change, then the yield to maturity is going to change. So the yield to maturity is no longer equal to the coupon yield. It's equal to the coupon yield adjusted for the value of the bond as it changes over time. So understanding this yield to maturity, being able to calculate it, and using it to compare different bonds is an important thing in fixed income investing. So leverage, and so we're talking here about capital structure, the fact that debt is lower in the capital or higher in the capital structure than equity, so it's lower risk. Debt investors going to get paid back before equity investors. Leverage is very important. So as corporations borrow more and more, their company gets leveraged more and more. The good thing about leverage is that the same amount of income results in higher and higher profits the more a company is leveraged. So there's, to some extent, there's incentive for a company to borrow more because it increases their profits, but it's also riskier. The greater leverage in a company, the more likely it is to go bankrupt when things don't go well. All right, so let's finish up just by talking about some different types of investors and kind of how they think about investing in bonds and their different perspectives and what they're looking for, and understand things that way. So obviously yield is a big deal. You want to know how much you're getting paid for owning this bond. We talked about term, duration, and interest rate risk, inflation, and whether a bond is indexed for inflation. Does the investor have income needs like a retiree or a corporation who just wants steady payments and predictable payments? They have confidence that the payments are going to be made. Credit risk and ratings, very important. We'll talk about those in a second. The perspective of an investor investing in individual securities versus an investor investing in a fund are very different perspectives on risk. And so that's a consideration that's very important. And then liquidity. Here we're talking about covenants in bonds. We just talked about this a minute ago, that a corporate bond may have requirements for the corporation, requirements that they need to follow for the bond to be valid. May need to maintain certain financial ratios in their accounting, limit on other debt they can take on, and so on. And then this is also where the call option, where the company can call in the bond when interest rates change, is there too. So credit ratings, very important aspect to bond investing. So we have credit ratings for both corporations and for countries, and they work exactly the same way. They're the same scale from AAA down to D, or really D means default, so it's really down to C, AAA to single C ratings. And you can assess the probability of default by understanding the ratings. So here we're seeing what we have on the y-axis here is probability of default on a bond, so from 0 up to 60%. And on the bottom we have the time horizon. So as time goes on, there's more and more likelihood that a bond could default. So obviously these lines slope upwards. Greatest potential for default for these triple C, or these are the C-rated companies, so the highest risk companies. You can see the risk of default in the first year is almost 30%, so very high risk there, whereas for a AAA company or government, the risk of default even over 20 years is almost zero. There are lots of statistics to back these up, that these ratings that are given are highly correlated with the probability of default. So understanding the ratings, understanding the level of default. So when we go back to that chart where we looked at the expected rate of default, we can get that from these lines. We can see the likely rate of default for bonds that are rated at different levels. All these statistics are out there and available from Moody's or S&P, the different rating agencies that assign these, and we can assess the likelihood of default and therefore the credit spread that we'd like to get in compensation for that. All right, so let me wrap up with a couple things here. I guess I'll talk about sukuk, which is really not a bond, but it's essentially the Sharia compliant replacement for a bond. First, let's talk a little bit about Islamic finance and just how it's growing and the different aspects of it. Talked a little bit about no interest banking earlier. So Islamic banking is 70% of the whole Islamic finance world. Here you can see the growth in the Islamic finance world over the past 10 years, or past 6 years, and then the expected growth going forward. So very big growth in the area. Islamic banking, no interest banking here. Sukuk, so the bonds, the replacement, the Islamic Sharia compliant replacement for bonds, 18% of these totals. Islamic funds, and Takaful, the Sharia compliant insurance, which is more kind of a cooperative type approach to insurance, is there. So Sukuk, different from typical bond ownership in that you really own a share of the profit of some project or company rather than just getting paid back a loan that was made, because of course interest is not allowed under the Sharia principles. The value is really determined from the underlying asset rather than from credit ratings and market interest rate. Fixed payments, whereas in Sukuk often the payments vary with the asset value. The way the structure works often is that the issuer that has the asset or project or business that needs funds sets up a special purpose vehicle. This vehicle then transfers profits. It's kind of like a asset-backed security that we talked about earlier. The investors then get a share of the profits. It may be a fixed share, it may be a fixed payment that's a share of the profits, or it may be a variable payment. But the profits come through this, are transferred through the special purpose vehicle. So it's just a way for the issuer to essentially loan money, but then pay it back without using interest. All right, so let me just cover one more slide here, which is just some different types of key fixed income investors in developed markets. So insurance companies, number one, they're the big fixed income investors. They have very predictable obligations that they absolutely have to make. So they're very safe in their investing. They use fixed income because they know it's going to make the payments when it's supposed to, and they're going to match that up with the timing of their obligations. Same thing with pension plans, although pension plans have a little less formal obligation to make the payments that they're required to. And then provident funds and retirement savings also. So all these different investors have different perspectives on the fixed income they're wanting to buy. Corporations and banks, of course, are also a fixed income investor, and they're going to be concerned with asset liability management, just like insurance companies and pension plans are. So a lot of the big institutional investors are very concerned about this timing of the payments and the coordination of that timing of payments with the obligations that they have to their either their depositors or their customers or their participants in a pension plan. I'll wrap things up, but just say a couple words on this last slide because it goes back to a point I made earlier, that an investor in fixed income can have one of two perspectives. They can either hold a bond to maturity and not be worried so much about how the value of the bond is changing over time, or they may be interested in trading the bond for something that's more valuable, or for whatever reason, selling the bond at some point, in which case they would account for it as available for sale. And they are very interested then in changes in interest rates and how the value of the bond is changing over time. At the end of this slide, there's some, or the deck, there's some resources to go to for more information on bonds and how to use them, how to analyze them, and so on. So I'll leave it at that, and we can have questions in the Q&A period. Thank you.
ሰላም ቤተሰቦቼ ክቡራንና ክቡራት የመቅረጽ ቤተሰቦች አብራችሁ ስለነበራችሁ እጅግ በጣም አመሰግናለሁ። የዛሬው ላይቭ ሴሽን ከዚህ ቪዲዮ ተጫውቶ አልቋል ማለት ነው። እንግዲህ ከዚህ በኋላ ጥያቄ የሚጠይቅና የሚሳተፍ ቤተሰብ ከሌለ ላይ ፕሮግራም ለመጨረስ እገደዳለሁ። ለመሳተፍ ፈቃደኛ የሆናችሁ የመጫወት ሀሳብ አስተያየት ለመስጠት ፈቃደኛ የሆናችሁ ቤተሰቦች ካላችሁ ከእናንተ ጋር ጊዜ ለማሳለፍ ዝግጁ ነኝ ማለት ነው። ስለዚህ እንግዲህ የተወሰነ ከኔ ጋር የምትቆዩ ሰዎች ካላችሁ በኮሜንትም ወይም ደግሞ በሊንኩን ተጠቅማችሁ ቀጥታ ጆይን በማድረግ ቪዲዮ ላይ አብረን መቆየት እንችላለን። ያማየውን ከሆነ ግን ያው ወደ ስልጠና እንሄዳለን ማለት ነው። ሀሳብ አስተያየታችሁን ለመለዋወጥ ፈቃደኛ የሆናችሁ የመቅረጽ ቤተሰቦች ካላችሁ ዋና ሴሽኑ ሳለ አሁን ኮሜንት መጻፍ ላይ ወራት ይቻላል ይችላል። ስለዚህ ግን ሊመቻችሁ ቤተሰቦች ከሌላችሁ የተወሰነ ደቂቃ ተጠብቃችሁና ላይ ሴሽናችንን እናጠናቅቃለን። እስከዚህ ሰዓትና ጊዜ ድረስ አብራችሁ የቆያችሁ ቤተሰቦች አብራችሁ ስለነበራችሁ እጅግ በጣም አመሰግናለሁ። በቀጣዩ ሌላ ዝግጅት እስከምንገናኝ ድረስ ያላችሁበት ሰላም ቆዩ። የዛሬውን ሴሽን እዚህ ላይ አጠናቀናል ማለት ነው። መልካም አዳር ይሁንላችሁ።